Hello traders, welcome back to our series where we talk about market analysis. Now, we talk about interest rate. That's the monetary policy of the central bank of the US. That's the Fed.
Is to carry on raising interest rates.
We're going to see rising rates.
Rising interest rates that will make the cost of borrowing go up.
It can send ripples across the whole economy. It can sink consumer confidence, result in fewer jobs and lower wages, and cause stock prices to fall.
If they go too far too fast, it can tip economies into recession.
So, why do central banks raise interest rates?
When we talk about interest rates, it's one of the most important factors affecting currency movement. When this news comes out positive, it affects markets drastically. And when it comes out negative also, same way affecting markets heavily. A high interest rate affects currency, increases the attractiveness for a currency, and a low interest rate decreases the attractiveness for a currency. Next is GDP. When we talk about GDP, that's gross domestic product of a country. GDP signifies the amount of goods and services produced within a country per a period. When there is high GDP, it increases the attractiveness for a currency, and when there is low GDP, it decreases the attractiveness for a currency or affects a currency pair. Now we're talking about CPI. CPI stands for Consumer Price Index. It's used to gauge inflation. That's defined as the rate of increase of prices of goods at a given time. When you talk about inflation, you know the increase or decrease in price of goods and services at a given time. CPI, Consumer Price Index, is a measure of the average price of basket of goods purchased by a consumer over a period of time. This basket of goods includes food, clothing, transportation, healthcare, and on average, the cost of expenditures of a consumer. CPI is generally released by the US Bureau of Economics and Statistics. So when there is high inflation or increases in the general price of goods in an economy or a country, it affects currency prices. And when there is decrease also, it affects the movement or the price of currencies. And these home items or urban consumer goods are being affected, likewise affecting currencies. Apart from those mentioned, fundamental analysis mentioned in our trading, we also have PPI, we have retail sales, balance of payment deficit, and other economic data. But the most important ones are what we just mentioned. That's CPI, Consumer Price Index, or interest rate or monetary policy by the Fed. We have the GDP, that's gross domestic product, and we have the most important, that's the NF, non-farm payroll use. So we end here with the fundamental analysis. We continue with the technical analysis.